Good morning. It is May 11th, 2021, and my name is Craig Moser, and I wanted to give you a brief update on what I see in markets and just in general, what's going on in the world here financially. So let's start if we can. I'm going to switch to my charts. I know everybody hates the charts, but that's what I do. So bear with me. And we will look for a moment at what's happening here, and I'll kind of let you know what I'm thinking. So we're looking back over 1 year. What a beautiful chart. That is the Standard & Poor's 500 index. And if you look at this and we're to measure from 12 months ago, I don't know, somewhere around May of last year, what a beautiful, beautiful thing. The stock market has rallied quite a bit. So I'll use the S&P as my example, and we'll look at that day a year ago and measure up, and we're somewhere up around 44%, 40, let's at least call it 40. Okay, so wow. If we make this chart look back for 2 years, you see a little bit of a difference there. So now we're looking back May of 2019, and that tilt has some aberration in it, if you will, has a little bit of change. So that percentage, can't really see it there, but that's something akin to about 41%. So all of a sudden, we cut our returns in half. Why? Because we had a significant decline. The markets pulled back. That's a no-brainer. You already knew that. But when you're looking at returns, you have to be conscious of where you're measuring from. And to me, it's sort of a significant thing to look at and say, all right, I need to make sure that I understand how I'm looking at things. So for me, you know, the further out we stretch this line, I know history is nothing, but over time, you can see that we've had a big tilt. Now we're looking for 5 years. Why did this come back so hard is something I want you to really think about. If you're passively listening to me, I want you to just kind of chew on this a little bit, if you will. The markets are up, because we're in really good financial shape and we're paying all our bills and everybody's pretty much at full employment, or B, we created a massive amount of capital and put some of that money to work in our economic system. So I tried unsuccessfully to figure out how much money has actually been paid out to people. I went several different places. Obviously, I searched on the internet and I saw the CARES Act. I saw the Consolidated Appropriations Act. I saw the American Rescue Plan. And then I saw different sets of numbers. So the CARES Act, basically, if you qualified from a income level, you got $1,200 for an adult. That was number one. Number two, the Consolidated Appropriations Act, $600 for an adult, $600 for each child if you qualified financially. American Rescue Plan, $1,400 for an adult, $1,400 for a child, again, if you met certain income requirements. So that's $867 billion. Now, I went on to the internet, yay, and in the internet, basically, I saw a bunch of different numbers. I saw $3.38 trillion as of last October in money being created. And so it's like, God, I just don't really understand where all that money went. And I'm sitting here today looking at you saying, I still don't know. So at the end of it, there's a lot of money somewhere, and it's in our economic system. Some of it, but in my calculation, less than $1 trillion went to us, the American people. So somewhere along the line, that money's somewhere in some system being used somehow. I do know that it stimulated the stock market because at the same time that all this money was created, interest rates were made very low. So if you have a low interest rate, you're not motivated to put your money into something that pays 0.5%. Let's be generous and say 1%, when it can't make any money for you. I mean, it's not going to inflate. It's not going to pay enough to even keep up with the inflation that we're seeing. So what you may want to think about is owning things that will inflate in value. People are concerned about the dollar. I hear you. I think you're a little early before thinking about the dollar is going to collapse. But the inflation part is pretty obvious. When you look at this stock market right here and say, that thing is on a tear. It's moving up to points higher than we've ever seen, ever. And then you ask yourself, how come? I think I answered it. There's a lot of money going in the system with no other place to go. Also, if you're looking at real estate, if you look at the value of private real estate, let's just say your home. So what happens there is, for the first time, at least in North Carolina, we're seeing people bid up houses, meaning you put your house on the market, you have multiple bids and the price goes higher. Go figure. Usually it works the other way around. So for us, we're seeing inflation in both the stock market and the real estate market. So you need to have some of those. Why? Because they're inflating. Duh. If you look longer term, the fear is that things are getting overpriced. If they become overpriced, eventually when they decline, the fall's pretty far down simply because they've gone up so much. So the S&P 500 is what stayed on the graph here, and you can kind of see that with a couple of pretty good dips, looking back over 5 years, but still having a pretty good rate of return over the past two because of the capital creation. So I mentioned bonds. Let's look at the bonds for a minute. And I'm not going to do all of these like I usually do. Here's the bond market. This is a 20+ year treasury, and this is the price, not the yield. So the pricing of iShares Lehman 20-year treasury bond ETF obviously has gone from 179 down to 137. That's not good. That means that money is not flowing into this. And when interest rates go up, the current value of this bond goes down. So I just said rates are low. But on the longer end of the spectrum, we had two things happen. Rates got dropped. So those very low yielding treasuries were issued. And now those treasuries are, with a little bit of increase in the interest rate, are actually going down in value. I'll explain that another time because I don't have time right now. But at the end of it, treasuries aren't helping us a whole lot if you're buying a long maturity one. Inflation bonds a little better. But what I'm trying to get you to is the real estate market and the stock market seem to be where all the money is flowing. So rather than fighting the trend and being a contrarian, probably ought to go with it. Just beware that you will probably see some decline percentages, in the future that might make you have to hold your breath a little bit. And I'm not saying that's tomorrow and you need to go to cash. I'm not saying any of that. But what I am saying is just understand what's happening in front of you. And this is not a natural flow of a stock market. This is not money that was on the sidelines that people normally invest. This is a lot of new money coming in. About 1/5 of the volume and quantity of currency that we have right now has been created since about March of last year. It's quite a thing to look at. The U.S. dollar. So when you look at the dollar, up and down, but down right now. So this is a 5-year look at that dollar. And so you can see we spiked up back in 2017, we declined in 18, we spiked up in 2020 when money, that was really the COVID thing right here, the dollar, and now we're down. So it can make you very uncomfortable when the value of your currency doesn't buy as much in the foreign markets especially. So anyhow, just wanted to give you some look at some of the things that are on my mind, some of the things that are bothering me. Inflation is bothering me. And so just don't put this money in a CD and think that's going to be able to keep up. I'm not saying you shouldn't have some money there, but I am saying that as you're looking at the future, understand that inflated assets are going to be required inside your portfolio to provide some of the growth. And also, you're going to have a mechanism in place to protect yourself when things decline beyond a certain amount. That doesn't mean zero decline. It just means that you need to understand what your comfort level is in an investment. And when it exceeds that downside and honestly upside, you need to do some rebalancing and take some profits or add to things that are incredibly low and allow yourself to either get an opportunity for appreciation or actually have a profit and take it. It's weird, but true. Anyhow, I don't want to go any further today. I don't want to make you pass out, but pay attention to what's happening. If you have questions, feel free to give us a call. It's 336-448-1086 here at the office, and we'll be happy to chat with you if you have some concerns or things that you want to talk about. And so with that, I'll let you go and hope you have a great remainder of your month.